Hi, everyone. This is probably the first time you see me on camera recording this. Instead of writing a blog post to talk about the previous month real estate number, I decided to just give it a try, record it with a screen sharing. Hopefully that will be more interesting for you. I'm not the most photogenic person on YouTube, and I might be rambling, so excuse me if that happens. Let's see. So hopefully you won't fall asleep. Hopefully we can keep it short, and hopefully it will take me less time to record this than to write an article. So let's give it a try. Okay, now let's first start sharing my screen. Okay, let's dive into the September data. Yep. Okay. So this is the number from the California Association of Realtors. If you look at the table, you'll see that all of this, each row represents a county, and these are median sales number across different counties. So let's take a look at the first row. Alameda County, we see a month-to-month price increase of 0.8, contract cost of 1.4%, marine 6.7. So if you keep looking, most of these numbers are not too bad. The month-to-month number is pretty stable. Some you have a little bit of slight ticking up, some are ticking down, with the exception of Napa. And if you compare with the previous year's number, this is fairly consistent with last year's number. Some counties are about negative, around 5%. Some are just about like last year's number. So this is not too bad, right? Given all of this talk about inflation rate and higher mortgage. So what's going on? So is the real estate market, starting to bottom out? Prices starting to come back? The answer is probably not. So remember, these are September sales numbers. September's real estate transaction, the numbers that we have here, they were closed in September. That means they went in contract in October. So what does that mean, right? It usually, from the time a buyer makes an offer, contract accepted, to the time the transaction closes, it takes about 30 days. So that's the time when buyer can go around, look for mortgage, find a good loan, find a cheap loan. So that means all of these transactions that close in September, buyer were looking for mortgage in August, sometime in August. And the reason that we see the market come back a little bit or staying a little bit positive, and that is primarily thanks to the mortgage rate in August. So if you look at the mortgage interest rate here, so right now we are at the end of October, we're looking at 30-year mortgage rate above 7%. If you go back in time, if you look at August, so that was actually a sweet spot. That's when buyers start to see, oh, mortgage rate came down a little bit. Let's take advantage of this short window and lock the rate and get in contract and buy something, right? So the reason that we are not seeing a continuous price increase in September sales data is because mortgage rates dropped slightly. Rate just took a little bit of break. Buyers got a little bit of break in August. So a lot of people got in contract, and people who need a home in the next 2-3 months, they know the interest rate is probably not going to stay low for much longer. So they jumped in, they got in contract, they locked the interest rate, and that helped boost the sales number for September. Okay, so now we talk about the sales number here. Let's look at the interest rate, right? So now we're at 7%. So when was the last time interest rate was at this 7%? If you go back, it was about 2007, 2006. We were as high as 6 point something, 6.43 over here, 6.72. 30-year. This is a website from Freddie Mac. So what's going on? So now interest rate is as high as back in 2007. And how about the rest of the metrics? How do the rest of the numbers look? So let's take a look at the sales data. And here we go. So this is the sales data of September. This is the bar. The final bar here is what we're looking at. And apparently we are at about 305,000 units sold in September across California. And if you go back in time to look at year 2007, when the sales was the slowest, so it was about 225,000 units sold at this period. So why? So apparently there's a big increase, right, from 305 to 225. So why do I show you this chart? This chart tells you, even in the very, very worst real estate market back in 2007, there was still 225,000 units sold, 225,000 families or individuals purchased homes, even during the worst housing crash. So what does this mean? These are people who really need to buy a home, and they're probably not investors, they're probably not speculators, and they just need a home. So this represents the hard demand of the real estate market in California. Even though things are really bad, there are a bunch of people due to life circumstances, lifetime events, people get married, people who are maybe got divorced, they just have to buy a home, have to sell a home. We still had 225,000 back in 2007. And today we are at about 305. So of course, the population of California increased over time. And so we have to adjust this number. So what I'm showing you is, let's say today, if interest rate was really, really high, people are unable to afford homes, and people are not willing to sell, people are not really wanting to buy. What is the hard demand of what's the amount of people that actually have to get a home, have to buy something, even though things are expensive, even though things are not looking favorable? How many people are there? Back in 2007, there was about 225,000 units sold. If we look at the growth in population of California from 2007 until now, so let's take a look. So this is the population number of California from 2007. Let's say it's about 36 million. Today we're at 39.2 million. Between these two, we had a population increase of 39.2 divided by 36 point 2007, 36.25. There was about 8.13%, 8.14% of population increase. That just based on this very rough estimate, right? If you look at this number, if back in 2007 we had 225,000 people have to get a home, have to buy a home, with the increase in population over 15 years. So what does that number become? So we will be looking at 243,000 units. So that means if economic conditions go bad, interest rate go up, people are very pessimistic about the real estate market, we expect there will be about 243,000 units sold still. So looking at comparing these two numbers, okay, it looks like we are not there yet. So there's still room for the sales to go down, because we look at this as like an lower bound of, in the worst case, what kind of scale of sales we would be looking at. Okay, now we know sales drop a lot, right? So year over year, 30% decrease in the number of units sold. But how about inventory? So let's look at the inventory data. This is a chart that I compiled from data from CAR, California Association of Realtors. You're looking at about 22 years of numbers from January 2020 up until actually This night, 2000. Oops, which one? Starting from year 2000. Excuse me. So I just hide some of the rows to make it a little easier to read. So now we see the sales has dropped so much, right? Do we have lots of homes sitting on the market? The answer is not really. We have 2.9 months of inventory on the market. So what does this mean, right? 2.9 months. To give you a simple explanation, if the market absorbs 10 homes in a month, that means 10 homes on the market get sold in a month, and you currently have 4 months, 40 homes on the market. That is 40 divided by 10. That you have 4 months of inventory on the market. So of course we're selling way more homes every month, and in fact the previous slide showed we sold the California as a whole sold about 305,000 homes in September 2022. And if you're just following that math, if we have 2.9 months of inventory on the market, currently we have about 884,000 homes on the market. That's what this number means. And so, and to put this in perspective, the median inventory since year 2000 was 3.4 months. So if you look at 2.9 compared to 2.9 and 3.4, we still have fewer inventory on the market than a typical year in the last 22 years. And this is not just California as a whole, but also the Bay Area. So Alameda County, Contra Costa County, if you look across the board, okay, the inventory you have is lower than the median value. And at one point, in year 2008, California as a whole actually had 16.6 months of inventory. That's when the market crashed. So compare this, if you look at this trend line, we actually don't have a lot of homes sitting on the market. This is just to begin to tick up from COVID. So if you go back a little bit from year 2000, you see that the inventory was pretty low. And when COVID hit, when the stay-in-place order went live, inventory ticked up a little bit in May, and after that, interest rate dropped. Everybody wanted to buy a home, wanted a bigger home. So inventory stayed really low, and it's just started to tick up in the last 6 months when interest rates start to go up. So so this is the reality we're living in. Price will go down, the inventory will go up, but we are nowhere near a level that we need to be alarmed. We are still below average, so to speak. So the conclusion is the real estate market is probably not going to bottom out yet. We still have over the last couple of months, we still have lots of big layoff news. This is something I pull off the internet. 19 biggest tech layoff. We have Tesla, 200 layoff from their autopilot division. TikTok, Coinbase cut 1,000 people. Netflix laid off 450. Twitter cut their recruiting team. Shopify laid off 10%. Robinhood cut 1/3 of their staff members. Lyft cut 60 corporate employees. Vimeo cut 6% its workforce. This list goes on and on and on, right? So these just happened a couple months ago, and frankly, its effect has not been reflected in the economic data, and is not even reflected on the housing data yet. The folks that are laid off recently, they will try to look for another job, and meanwhile cut down their spending. So all of these changes is going to trickle down to the mainstream, to the Main Street economy, as well as the housing market. These people will be, if they already have a home, they will maybe, if they cannot find a job in a short amount of time, or find a job with similar pay, they may consider selling. They may consider getting out of this, getting out of the home ownership. So this is gonna put more listings on the market. So the worst time is not here yet. I think we are getting in year 2023, we will see real estate price will go down even further. So on the other hand, we know that the Federal Reserve has tightened its monetary policy. This is the chart of the Federal Reserve balance sheet. At its height, it was at close to $9 trillion on the balance sheet. So since COVID started, they started to buy assets like crazy. They bought a lot of different bonds, municipal bonds, corporate bonds, mortgage-backed security. That is what fueled the low interest rate, fueled all of the refinance and real estate purchase boom from year 2020. And now the Fed wants to reverse this trend. They want to sell off the asset. They no longer want to buy. Actually, they stop buying mortgage-backed security. So this trend, as it continue, as the Fed try to reduce its balance sheet, the mortgage rate will stay high. Okay, even though let's say unemployment start to go up, Federal Reserve stop hiking their federal funds rate, they still have a lot of mortgage-backed security on their balance sheet that they have to offload. So they will continue to sell mortgage-backed security and also those 10-year Treasury bond, which is closely linked to mortgage interest rates. So as long as they keep selling it, the yield will remain high and the interest rate on mortgages will remain high. Okay, so what's likely going to happen is they will keep hiking the federal funds rate, and my guess is they won't stop until the unemployment rate goes up. Even then, I think Fed Chairman Powell, he's looking at these 1990 golden years as a reference. Okay, so he will feel very comfortable keep hiking rate until we get to about 5%. At that point, if unemployment rate takes up, he needs to save Main Street, then he will think about lowering rate to stimulate the economy a little bit. But meanwhile, this balance sheet is going to take a while to shrink, and interest rate for mortgage will continue to be high, even if the Fed lower short-term rates, such as the federal funds rate. So that's it for this week, and actually this month. I hope this helps, and yeah, give me some feedback, write back, and let me know whether I should continue to do a video recording like this or go back to writing a blog post. Yeah, so see you next month.